There is a question that keeps coming back every time tech goes through a period of excitement. What if the current AI boom is not a breakthrough, but a classic financial bubble getting ready to burst before asking who might profit from a collapse? It is useful to understand what a bubble actually is. A bubble happens when prices rise faster than reality can justify. It is when expectations grow faster than technology, faster than revenue, and faster than the ability of companies to deliver what investors imagine. In simple terms, a bubble is a gap between the story people want to believe and the numbers that actually exist underneath. It is not necessarily a scam, and it is not always intentional. Sometimes people become so convinced that something will change the world that they stop checking whether the facts match the enthusiasm. So, is AI a bubble? The honest answer is that parts of it might be. Some companies have huge valuations with very little revenue. Some products are still experiments, but are priced as if they will dominate entire industries overnight. Some of the excitement comes from impressive demos that do not always translate into daily use. At the same time, AI itself is real technology. It is improving, it solves problems, and it will not disappear. The question is not whether AI is real. The question is whether the expectations placed on it are realistic or inflated. Could the AI boom pop? Yes. Every period of rapid excitement is vulnerable to correction. If costs stay high, if usage does not grow fast enough, or if companies cannot turn prototypes into stable services, investors may decide that the future will take longer to arrive than expected. That alone is enough to trigger a slowdown or a drop in valuations. Historically, most technological revolutions go through this cycle. Optimism, over-optimism, correction, then slow and steady growth once the noise fades. AI may simply follow the same pattern. If a correction happens, people assume everyone will suffer equally. But that is not how markets work. Retail investors and late-stage buyers are usually the ones who lose the most because they enter when prices are already high. Startups that rely entirely on hype rather than solid revenue tend to struggle as funding becomes more selective. Even large tech companies can feel short-term pressure if investors lose patience with long-term promises. But not everyone is hurt. Some groups quietly benefit when a bubble pops. Early investors who entered at very low valuations often keep their gains even after a correction. Hedge funds that prepare for both directions can profit from volatility, whether prices rise or fall. And the companies that sell the infrastructure behind AI, like cloud services and chip manufacturers, have already secured long-term contracts. They continue earning even if enthusiasm cools down. They made their money during the rise, and the obligations remain in place during the slowdown. This changes the way you see the AI boom. Instead of viewing it as a dramatic mystery controlled by secret forces, it becomes a familiar cycle, where excitement, correction, and long-term progress all play their part. And once you know who gains and who loses at each stage, the motivations behind the headlines start to make a lot more sense. If you found this explanation helpful, consider subscribing to Simple Revenues. It helps the channel grow, and you will get more calm and clear perspectives on how money really moves behind the stories we hear. Thanks for watching. Simple Revenues, finance made simple.